Navigating a bear market can be agonizing. Watching your investments drop more than 20% can be nauseating. Even if you're a disciplined, long-term investor, it can be hard to stay invested and simply wait it out, keeping faith that the stock market will recover and with it, your portfolio. This intense discomfort and uncertainty leads many investors to sell out of stocks, often to their detriment. Unfortunately, this only becomes clear in hindsight. Selling may give you some temporary peace of mind, especially if stock prices end up dropping even lower in the near term. But if you sell, you'll face another important and difficult decision. When should you reinvest in stocks? Our short answer is this: it's often better to buy back in before you get an all-clear signal the bear market is over. Otherwise, you risk missing out on some of the sharp recovery that so often follows a bear market. We'll explore this idea in 3 parts. First, we'll offer a historical perspective on bear and bull markets. Then we'll look at why there's no all-clear signal telling you when it's safe to reinvest. Lastly, we'll look at how missing the start of the next bull market can be costly because bear markets are often followed by a sharp, V-shaped recovery in stock prices. Bear markets have always been followed by bull markets, and bear market declines are erased by the subsequent bull market's gains. Bull markets also tend to last longer and rise much more than bear markets fall. This is important for any stock investor to keep in mind, especially during the depths of a bear market. If this weren't the case, the price of stocks would not move higher over time. The cumulative return of the last bull market, which ran from March 2009 to February 2020, was 401%. This dwarfs the decline of the previous bear market. This may be obvious, but to reap the full benefits of a bull market, you need to be invested for the entirety of the bull market. Some of the biggest gains happen on just a handful of individual days. If you miss even a few of the best trading days, your long-term returns can be substantially less. For instance, if you were invested in the S&P 500 from January 1988 to the end of March 2020, you would have realized an annualized return of 9.8%. But if you missed only the 10 best trading days, your annualized return would have dropped to 7.4%. And if you missed the 20 best trading days, your annualized return would have fallen to 5.7%. We never know when those big up days will come, but we do know missing them can set you back significantly from reaching your financial goals. When we look at market returns over many market cycles, we see just how much stronger and longer lasting bull markets are compared to bear markets. In the 11 bear markets since 1946, shown in the red areas and not including the one from 2020, the S&P 500 price index declined from peak to trough 34% over 16 months on average. During bull markets, by contrast, the S&P 500 price index rose an average of 172% over more than 5 years. Every cycle is different, of course, but the long-term trend is very clear, as is the lesson for the long-term investor. Bull markets are longer and stronger than bear markets. Even knowing all of this, say you still decide to sell out of stocks during a bear market. What next? You could wait until negative economic news starts to improve or the National Bureau of Economic Research declares the recession over. But by that time, the economy may already be in expansion and stocks well into their rebound. So is it best to wait until it's certain the bear market is over and a new bull has begun and all is clear? As counterintuitive as it seems, you may be better off re-entering the market before you get an all-clear signal the bear market is over. Why? There's no surefire way of knowing when a bear market will end. If there was, everyone could navigate bear markets perfectly. But unfortunately, there will be no all-clear signal telling you when it's safe to get back in. Waiting for certainty comes with potentially high opportunity costs. An opportunity cost is an implicit cost, the return you gave up by making the choice you made. In this case, staying out of stocks may prevent further losses, which sounds pretty good, especially if you've already watched your portfolio lose 20% or more. But it also could mean you miss out on returns in the next bull market if you stay out of stocks for too long. These early returns tend to be sharp and fast, and they can be essential to recovering from the bear market. Bull markets often start with a bang, what we've termed a V-shaped bounce. You can think of a bear market as a spring. The more you push down, the bigger the potential bounce on the other side of the bear market. Stocks often take off like a bullet. Here you can see global stock market returns for the 2008 bear market's final stages and the new bull market starting in March 2009. It's a typical V-shaped rebound. Here, the new bull's trajectory nearly perfectly mirrored the end of the bear. And the global stock market had a historically massive bounce off that bottom, rising 73% from March 9 through year-end 2009. Missing out on a bull market's beginning can cause huge missed returns and hurt your chances of achieving your long-term financial goals. If you decide to sell your stocks in the middle of a bear market, you may feel better for a time, but you may end up doing more harm than good. It's human nature to want to feel some control over what is happening. Many investors feel that selling during a bear market gives them control and lets them avoid further declines. However, this is an illusion, and that feel-good action may not have a happy ending. Missing out on a bull market's initial months or even weeks can be very costly. Too often, investors who sell during a bear market miss this initial upswing and end up incurring bear market losses and missing some of the bull market's gains. Being fully invested for the initial takeoff of a bull market can help erase a big portion of your bear market losses.